100 basis points. Does it happen from the Fed? It happened with the Bank of Canada. Joining us now, Katrina Dudley, Franklin Mutual Advisors, investment strategist and portfolio manager. Katrina, 100?
Nope, it's not happening. They are not doing 100. The Canadians may have done it, but the Fed, I think, is likely to stick to the 50, 75 basis at the most aggressive.
So 75, Katrina, what does that do to current asset prices?
I think the market's already pricing this in. That's the nice thing about having the Fed forward guidance. And I think that the market is already adjusted to that. You've seen that in terms of multiples starting to compress. You've seen it in the profitless tech sector, where you've seen a lot of that sell off already. As we look at it, though, we're in a situation at the moment where these rate rises are coming as growth is starting to slow. And that's a real concern because you have high inflation and low growth. And if you look over to Europe, that is a very untenable position that the ECB is in, and now potentially the Fed's going to be in.
So let's just say for the Fed for just one more second here. So even if they don't go 100, how many 75 bips can they get to before they break things?
I think it's very difficult to tell because everything's moving. You have a look at the situation with the energy prices here in the United States. You look at what that's doing to the low-end consumer. You see that through the retail numbers. So there's a bit of a trade-off where we have other factors now that are influencing the market. Yes, we're all talking about rates and we're talking about inflation, but there are a lot of other factors that are going to play into whether or not the Fed does 175, does 2, or even 3.
Katrina, I hear what you're saying, and you're talking about a lot of moving parts. Your degree of certainty as to what the path between now and year end looks like for the bond market, the treasury market, the S&P, how easy is it to pick it in this kind of environment? We're trying to work out what happens with inflation. We don't really have a huge handle on that, it seems. We're trying to work out what happens with growth. We could be about to see a recession in the United States, certainly Bank of America pointing to that possibility. But it's very woolly. It's very hard to see what's going to happen here. I don't know, therefore, how I can extrapolate back into markets to get a good handle with any degree of certainty without a huge amount of volatility in my portfolio.
Yes, I think volatility is here to stay. If I look at what's happening in the market, we're starting to see signs of growth slowing, and a lot of that is driven by pricing now starting to impact demand. So if you look at Parker Hannifin, which is a quintessential, short cycle industrial company, Evercore ISI just surveyed all of their North American distributors and found out that their ability to pass on these higher costs through bigger price increases is starting to kind of come under pressure because they're seeing the demand destruction. And that type of tightrope that companies are walking is similar to the tightrope that the Fed needs to walk. They need to raise rates in order to curtail inflation, but they can't raise them too much that they start to generate, as you talk about, a recession. The other thing that we're a little concerned about is that we talk ourselves into a recession. And if we do that, though, we think it'll be much more of a mild recession than a significant, large downturn in the economy. And that's driven by a number of factors in terms of you look at the housing market and the stability and the lack of supply we have there, and that will generate, economic activity. We look at the supply chain challenges, and those supply chain challenges means that there's not a lot of excess in supply chains and inventory levels. So we're actually kind of positive that even if we do have a recession, it's going to be a small blip on the horizon. So as you take that and you look at companies, instead of having your significant declines in revenues, maybe revenues flatten out and are down slightly. So the earnings hit is going to be much more manageable this time around.
So where do you go in that environment, particularly as cash is now worth something? So there's also a case to be made for just sitting in cash until we get that kind of clarity. Otherwise, where do you put it?
Look, sitting in cash, though, with inflation at the levels that it is actually still value destructive. So I'm not necessarily sure that cash is your best alternative here. So one of the sectors that we're very positive on is I've talked about the home building sector. And I think this is a situation where you need to separate out stocks from your perception of what's happening in the general home building market. A lot of people are thinking after significant price rises and the increase in mortgage rates that people are not going to be buying houses houses. We don't think that is the case. We think that the market is very undersupplied, and we're extremely positive on the ability of the home building sector to meet that increasing demand. And that demand is actually driven by life changes, people having children, needing bigger houses, and not wanting to, live in a small one-bedroom apartment. So those demographic changes are supported by a strong economy, and we think that that's going to drive the home builders and be positive for them.
Katrina, if the Russians cut off the gas to Europe, if Europe goes into a free fall economically, what impact does that have feeding back into the US market?
If the Russians do cut off the gas, I think the hit to GDP next year is estimated about 3%. Obviously, there are some offsets that can happen. We can have imported gas coming into the market. Canada's looking to play a big role there. We can have an accelerated shift to renewables, and there are other different forms of energy. So I think that there are ways to offset that fairly significant hit if Russia was completely cut the gas off. And Europe's already announced an intention to basically wean itself off Russian gas, and Russia knows that. In terms of the trade-off, however, we're looking at an ECB that's facing increasing inflation pressures. Those are driven by higher food prices, the result of the Ukrainian crisis, as well as higher energy prices, which are also. So what could happen that's positive? Because I hate always talking about the negative. Maybe we do have an abrupt end to the active war in Ukraine, and that will cause gas prices to normalize to a much more manageable level. We'll start to see those food supplies come back on. And that is the surprise that could come in the second half of this year. And I think if that happens, all this talk about a recession will be taken off the table.